Trade wars have a powerful impact on the Forex market, and understanding how they play out can help you become a smarter, more strategic trader. Let's dive into what really happens during a trade war, how currencies react, and what kind of insight can give you an edge when the market gets volatile. So, what exactly is a trade war? At its core, a trade war is when two or more countries start imposing tariffs or restrictions on each other's imports and exports. The goal? Usually to protect domestic industries or force the other country to negotiate better trade terms. But in the Forex world, it sets off a chain reaction. Imagine this. Country A imposes high tariffs on goods from country B. Country B retaliates. Suddenly, the companies in both countries face higher costs and less global demand. Investors start pulling out money, stock markets wobble, and currencies start to swing. The first thing you'll often see is a hit to investor confidence. When confidence drops, people move their money into what are known as safe haven currencies like the US dollar, Swiss franc, or Japanese yen. But here's where things get interesting. The actual impact on a country's currency depends a lot on the structure of its economy. Countries that rely heavily on exports usually suffer more. Their currency often weakens because the expectation is that their economy will slow down. On the flip side, if a country's domestic economy is strong and it doesn't rely as much on trade, its currency might actually hold up or even strengthen. Take the US-China trade war, for example. During the height of it, the Chinese yuan depreciated against the US dollar as tariffs hit Chinese exports hard. At the same time, the dollar gained strength not just because of safe haven status, but because US interest rates were relatively higher, attracting foreign capital. Now, as a trader, how do you prepare for or respond to these situations? This is where it becomes less about prediction and more about preparation. Trade wars create uncertainty, and uncertainty creates opportunity for those who are ready. That means staying on top of news, watching economic data, and understanding how different pairs move in relation to risk sentiment. This is also where using a comprehensive trading system can make all the difference. For instance, a tool like the Trading Management Solutions EA from TakePropips gives traders a serious edge during chaotic times. It's not just about setting stop losses and take profits, it's about automation, analysis, and real-time insights. When the market is reacting to sudden news about new tariffs or retaliatory measures, speed and clarity are everything. The EA's built-in trend scanner and currency strength meter help you visually identify strong versus weak currencies. That's crucial in trade war environments where sudden shifts in strength can happen overnight. Combine that with trailing stops, break-even SLs, and even partial closes, and you've got a system that helps you lock in gains and protect yourself against reversals. What's also powerful is the AI-driven analysis built into the platform. It can analyze economic data and recent news to help you understand potential market movements even when the headlines are all over the place. This kind of insight is especially helpful when you're trying to navigate the long-term effects of a trade war, not just the short-term reactions. And let's not forget automation. When a trade war escalates overnight and the market gaps open, having automated systems in place can mean the difference between catching a great entry or chasing the move too late. Whether it's auto trading, task scheduling, or setting protective rules like drawdown limits, being proactive is key. In short, trade wars may be driven by politics and policy, but the fallout is all about market behavior. And if you're equipped with the right tools and mindset, you don't just survive these volatile periods, you capitalize on them. Stay informed, stay disciplined, and most importantly, stay ready.